week of earnings on the stock market last week. The biggest story was Nvidia, a semiconductor manufacturer that saw its earnings and revenues triple and saw its stock soar as a result, and thus push up the whole stock market as a result, as all the excitement around AI computing and demand continues to push markets higher. I don't actually have a lot to say about that this week, though. Instead, I want to talk about Berkshire Hathaway's earnings, which came out over the weekend. Warren Buffett's company is always a fascinating one to look at to get a sense of what's happening in the economy at large, and that's what we're going to do in today's video. I'm also going to put out a video in a couple days on Warren Buffett's annual shareholder letter, so stay tuned for that. And in the meantime, this is the long and the short of the markets. My name is Daniel. Let's get started with Berkshire Hathaway. Before starting, let's review why I like to talk about Berkshire Hathaway's earnings. It's not because I'm a Berkshire Hathaway shareholder, though I am. I hold its shares sort of like I would hold an index fund. I think it's a little bit better than an index fund, a little bit more active, but as Warren says himself in this year's letter, you're not going to expect a lot of outperformance owning Berkshire Hathaway. You can expect that things won't go terribly, but it's a huge company with so many diverse arms that it's hard for it to perform greatly. That said, I like to study it because it is a diverse company with tons of different business units. We can learn a lot about the broader economy because we're seeing so many different aspects of it all under one roof. And we can learn all that because Berkshire is run by Warren Buffett, considered the greatest investor of our age, and up until a couple months ago, the late great Charlie Munger, Warren Buffett's vice chairman and also a legendary investor. How they think about business is imbued in Berkshire Hathaway and in how the company writes its annual report and in how they talk about the business. And so we can both reverse engineer their investment thinking, and also we get a great deal of disclosure, a great deal of information about these businesses. So we actually get some good details that we can then extrapolate from to think about the economy at large. That's what we're doing here. So without further ado, let's start going into some of their business units and the big stories from 2023 for Berkshire Hathaway. Berkshire saw its operating earnings, the key metric I'm going to be focused on here, grow $6.5 billion in 2023 versus 2022. 21% growth. Impressive. Nice numbers. More than $6.5 billion of that improvement came from its insurance business. Its best known, most classic business, what you associate with Warren Buffett and Berkshire Hathaway. What happened there? How did it swing so drastically? It went from an underwriting perspective, meaning its actual nuts and bolt insurance business, how much money you collect from premiums versus how much you pay out to policyholders, essentially, for claims. It went from a tiny loss, relatively, about $30 million loss in 2022, to a $5.4 billion gain, a $5.5 billion swing when you round. What happened? A couple of its insurance lines are more geared towards property and reinsurance. And in their case, what happened was more what didn't happen. There was no major natural disaster that was a catastrophe for the insurance business. There were no billion-dollar, multi-billion-dollar losses to pay out, and so the business banked a gain last year. Though I believe its gains were record highs, which is more a sign of the continued growth in policies over time. But the bigger change happened in Geico, Berkshire's auto insurance business. The gecko, of course. I've talked about this when we did our Q3 video 3 months ago. Geico struggled in 2022, and the auto insurance industry has been at the heart of the challenges that we faced with the pandemic and then with inflation. I own Progressive as well, Flow, and I follow this industry closely and find it interesting both for my own portfolio, but also precisely because of this challenge with inflation. Let's talk about Geico. It swung from a $1.88 billion pre-tax loss in 2022 to a $3.6 billion gain in 2023. How did it swing so severely? Keep in mind the backdrop, first of all. 2020, these companies minted money because we weren't driving, so we weren't in accidents. It even returned money to policyholders. 2021, we start driving again. We start driving worse. So there's more, higher frequency of claims. And those claims are worse because it's more expensive to repair cars, especially. Property damage, collision, and bodily injury pricing all goes up. It's more expensive for these companies to pay out the claims, and so they're losing money or not making as much money because their pricing for their policies hasn't adjusted. 2023, Geico and Progressive and other companies adjust, raise prices, and become much more profitable again. That's a big part of Geico's story. Its profitability goes up meaningfully. It reduced advertising, and that combination means that it had fewer policies in force, so it actually lost customers last year. But with that increased pricing and claim severity rose last year, meaning it was still more expensive to repair cars and so on, 2023 and 2022, that declined. And it even appeared to have declined how much it rose from Q4 in Q4 as compared to Q3. So this seems to suggest we're getting a handle on the inflation problem in this industry, which is an encouraging sign for the broader economy. It's an encouraging sign because we should see Geico, Progressive, and so on compete more for our business, meaning they will advertise more, good for advertising businesses. And in theory, they'll compete more on price, which will be good for us as customers. But that's the main story in the insurance business, which saw Geico set a record, and I believe saw the other business lines set a record. Very impressive stuff. If you're paying close attention to my math, you'll notice I said that Berkshire's earnings grew $6.5 billion. And then I talked about how underwriting saw its growth $5.5 billion. And you'll say there's $1 billion missing. And I said that insurance was more than the $6.5 billion. The rest of it comes from investment income, which is a reminder of what a great business the insurance business can be, which we've known from Berkshire and from other companies over the years, but it's always fun to see how this plays out. What do I mean? As Warren Buffett will always tell us, and as the company has been putting a page in front of their annual report each year for the last 5 years, the insurance business runs on float. We pay premiums, and then if we have a claim at some point in the future, the insurer pays us back out for those claims. That's the deal. Premiums are now, the claims are later. In the meantime, that money is float. It's available to the company to invest. Berkshire invests that money. It invests in stocks, which we'll talk about in a little bit, but it also invests tons of money in treasury bills, short-term bonds from the US government that, as you may have noticed, started paying out more over the last year or two. Bond yields went up meaningfully. And because Berkshire is geared towards short-term bonds, they didn't get hurt by prices. So their value of those bonds didn't drop. And all of a sudden it started making lots more money. $4.4 billion in pre-tax investment income from just this line, the interest income and other income. Berkshire's dividend income actually decreased a little bit last year as it sold stocks throughout the year. But with that interest income increasing, that's a huge jump. And that explains why Berkshire's insurance business on its own more than makes up for the difference in operating earnings last year. It's not insightful to say that the insurance business is a great business when done well, but it is fun to see that proved out again and again over time in Berkshire's results. If insurance more than makes up for the growth in operating earnings, obviously there are other places where the company lost operating earnings versus the prior year. I'll talk again about Buffett's letter in a different video, but he points out the challenges in the railroad business and the utilities business, both of which saw declines in earnings last year. I'll talk about them both as well because you can see that the causes appear to differ when you drill into the numbers in either case. The railroads business, Burlington Northern Santa Fe, is the healthier business in my view. It did see a decline in earnings from almost $6 billion to a little over $5 billion, $900 million in earnings. That's meaningful. And it saw a bigger decline in revenue. And that's where I start, revenue. Volumes were off in each of their lines. They have coal, they have industrial products, they have consumer products, they have agricultural, I believe is the fourth. Consumer products was the big drop off. And when you look at it, it's actually not as bad as it sounds from a broader economy level. Not great for Berkshire. Why? It lost business due to reduced volume, but not necessarily due to reduced demand. It lost a key customer in the intermodal business, meaning shipping that goes from ships to trucks to trains and so on back and forth, switching the modality. It lost business there, and it lost some business from competing with competitors. Competition beat them for some of that business. It didn't seem that Berkshire lowered its price in any way in that line, suggesting they were able to maintain their price, or that the trade-off between price and customer played out for them. That's something that's within the company's business to control. That played out in the other lines to a lesser degree. And Buffett grumbled in his letter about how wages grew more than inflation as a result of the government getting involved. Wages didn't seem to have a major impact on the results, at least in the numbers that I see. It could get worse next year. I guess we'll see how the contract plays out over time. But all in all, seems like the railroad business still pretty solid place. $5 billion in earnings is a pretty solid place. To me, it looks like a slight cyclical pullback, and we should expect it to grow over time. Utilities is trickier. Utilities, the pre-tax earnings dropped 70%, and the overall earnings dropped 40%. Both big drops. Utilities is a weird place because it actually gets income tax benefits or income tax credits for investing in wind energy, for example, and other renewable sources of energy. And it's a tough business because it's always closely regulated because it's an essential need. Utilities are essential businesses, electricity mostly. Also, some natural gas for heating is in there. And ultimately, you're going to have to work closely with government. Government usually gives you a little bit of an opportunity for a certain fixed return and then some chance for outperformance. That's how Buffett puts it in his letter. And with the stress of climate change, with the stress of investing in new technologies, with the stress of building out transmission, which is the big bottleneck from what I can understand in US power generation, improving power lines, putting them underground, and so on. It's huge costs that somebody has to invest in. And if you're running a business, you have to make a profit out of it to justify it. So it's a tricky spot. And I understand Mr. Buffett's crankiness on this front. I don't know where Berkshire is going to go with this. I don't invest in utilities outside of the fact that Berkshire owns this business line. I don't know. It's a tricky spot. It's understandable that there's some crankiness on Mr. Buffett's side, and we'll just have to see how it plays out. That is a trouble spot to watch going forward. I mentioned how Berkshire is a conglomerate, and one way to think about Berkshire as a business is that it's its own diversified portfolio. Even though the way that Buffett and his fellow investment managers at Berkshire run their stock portfolio is relatively concentrated for how big the company is, the business itself has a natural diversification which allows you to offset certain risks, which is sort of the point of diversification. It's so that if one thing goes bad that you can't control, at least you have something else to offset it. Let's look at Berkshire's businesses. I mentioned the utilities business, and they lump in Pilot Travel Centers, its newest acquisition, in that business line. Pilot Travel Centers is a gas station business. It makes more money when oil prices go up. Conversely, the railroads business has oil and fuel as a cost. So if oil prices go up, that's bad for the railroad business. So that's a natural offset within the business where the company does well either way. You can throw in natural gas from its utilities and so on. Lots of different, I'm simplifying here. Another example, insurance businesses can do well when interest rates go up. We just talked about how much more money the company is making from investment income by investing in short-term treasury bills. At the flip side, that's a bad sign for housing industry and for home builders and so on. People are less likely to buy houses when interest rates are high and mortgages are more cost prohibitive. Berkshire Hathaway has a whole building products unit, including mortgages, including home selling, including building and so on. And so that struggled last year. Again, these natural trade-offs. I don't think that as they built Berkshire Hathaway over the last 50 plus years, Buffett and Munger actually said, all right, we can buy this business because it'll offset this business. I don't think they constructed it so predeterminedly. I am sure that as they bought a certain business, they saw how it fit into their portfolio and how it might add to the value of Berkshire as a whole. They bought it, I'm sure, from an absolute perspective. This will absolutely be a good investment. But if it fits in nicely to the broader conglomerate, that's also a plus. It's a good lesson for us as we think about how we build our portfolios, how we can consider how we want to get absolute value from every purchase, but also this might serve a purpose of offsetting a risk I have somewhere else. Another investment lesson comes from one of Buffett's self-described big mistakes, precision cast parts. In its 2020 letter, Buffett talked about how he overpaid for precision cast parts. He thought that their average earnings would be higher over time. Paid too much, they wrote down $10 billion of a $37 billion purchase price from precision cast parts. That hurts. That's a big drop. That said, precision cast parts, which makes parts for planes essentially, saw its revenue increase 22% last year and its earnings increased 30% last year. Its revenue is still 7% lower than its pre-acquisition high, and its earnings is still 40% or so lower, if I'm not mistaken, than its 2014 levels. The acquisition happened in early 2016. So that's still rough, and there's still either room for improvement or else this is permanently not as good as it looks, which is ironic because when Berkshire bought Precision Cast Parts, the dominant narrative was that Berkshire was getting another steal, buying a company at a temporary low, and what bandits they are, what lucky guys they are for buying at the right time. Hasn't played out that way. But my broader point is actually this. 5 or 10 years from now, when Precision Cast Parts is setting new records and making new record distributions to Berkshire Hathaway, I don't know how much shareholders are actually going to care that Berkshire overpaid by that point almost 15 years prior. That's just the reality of how things work. If you go on a long enough time horizon, the Precision Cast Parts buy will end up looking, I think, pretty good for Berkshire Hathaway, which is just a reminder not to buy willy-nilly and that you can make mistakes in valuation. But if you buy well and have a long enough time horizon, if you avoid permanent loss of capital, as Berkshire constantly stresses, chances are things will work out pretty well. The last thing I want to talk about is Berkshire's buying itself last quarter. Everybody likes to look at what Berkshire's doing in the stock market because Buffett is the so-called Oracle of Omaha, and it's interesting to see what this major investment firm, which is one way to think about Berkshire, is doing with its money. In Q4, the company bought twice as much of its own shares as it did in Q3, 2.2 billion versus 1.1 billion in Q3. So that's the first thing, share repurchases. That's still less than Berkshire was buying at the first half of 2023, but it's just an interesting note, picking up the volume of share repurchase, which is the main way that Berkshire Hathaway returns money to shareholders, essentially by buying them out and giving them a chance to exit at what they would argue is a fair value. Berkshire didn't make any huge purchases of a company last year. The biggest thing they did was increase its ownership of Pilot Travel Centers, which I just mentioned, increasing ownership to 80% in January of last year. And in 2024, January of this year, Berkshire took the full 100% ownership of that business. There were no elephant hunting. There was no major buying that Berkshire did as a whole. In buying stocks, Q4 marked the first quarter that Berkshire was a net buyer of stocks since Q3 of 2022. So it broke a 5 or 6 quarter streak, if I am doing the math, 4 quarter streak, doing the math in my head. Was only $525 million in net purchases last quarter, which is not a major number for a company the size of Berkshire Hathaway. And so I'm not going to go and say Buffett is now bullish, Buffett is buying again, or anything like that. It's just interesting to note that the company on a whole found more value in putting money to work than in selling stocks last quarter. Is it because there was a dip in October and November and there was an opportunity to get fair prices? I don't know. Too much to speculate. And it could be that the investments are going into the Japanese stock market, purchases that Berkshire Hathaway's made or somewhere else. But on the whole, interesting to note that the Berkshire Hathaway did a little bit more buying in the last 3 months of last year than it did in the prior quarter. Using last Friday, February 23rd, 2024's close, Berkshire Hathaway trades at 24.1 times its operating earnings. That's probably the best way to look at, the simplest way to look at Berkshire's value. You can look at it a number of ways. You can slice and dice the sum of the parts. You can look at how to factor in its holdings in various publicly traded stocks. You can talk about the value of its cash and short-term bonds in the balance sheet versus its debt, all these sorts of things. You can talk about its book value, which is a little more old-fashioned. I think the simplest way is to just say 24.1 times operating earnings. Compare that to the S&P 500, which has a 23 times trailing 12 months price to earnings ratio. Berkshire is a little bit more expensive than the S&P 500, which seems to me like a fair price to own Berkshire Hathaway shares. Without making any investment advice, Berkshire Hathaway has this wide range of businesses across the US economy. It has great management. It seems like it'll be around for a while without major risk of losing your money permanently. And for that, paying a little bit more than the market multiple seems acceptable. But whether or not it's a buy is really not the point of this video, and I'm not going to be doing any fresh buying anytime soon. The point is, Berkshire is not just one of the biggest companies in the world. It has one of the most broad swaths of businesses in the world. And all these different businesses in its collection are interesting to study because we can learn a lot about the broader economy and about other investments that we might make. That's what we did on this video. Check out my video that's coming out on Warren Buffett's annual shareholder letter and things we can take away from that. My name is Daniel. This has been the Long and Short of the Markets. Thank you so much for watching, and subscribe to this channel. Check out middlecoastinvesting.com for the written version, and I hope to see you next time.